In the high-stakes poker game of global finance, few players have captured the public imagination quite like Michael Burry. Portrayed with brooding intensity by Christian Bale in the Hollywood hit The Big Short, Burry is the financial wunderkind whose foresight into the 2008 housing bubble transformed him from a market whisperer into a Wall Street legend. Rewind to 2005, when the housing market was the belle of the economic ball. Burry, with a discerning eye, saw through the glittering facade. He perceived the market as a precarious bubble teetering atop a mountain of high-risk loans. With the acumen of a chess grandmaster, he devised a novel strategy: the credit default swap. This financial instrument, as elegant as it was daring, allowed Burry to bet against the housing market, effectively shorting it. He was selling positions with the conviction that housing prices would eventually plummet. Banks and creditors balked at Burry's strategy, seeing it as a foolhardy challenge to conventional wisdom. Yet, in a turn of events that would befit a Hollywood script, Burry's audacity paid off. When the housing market did collapse, those who clung to his coattails reaped the benefits. His strategy generated almost 500% returns for the investors who had the stomach to stay the course through the tumultuous period. In the aftermath of the 2008 financial cataclysm, Burry didn't rest on his laurels. He closed Scion Capital, only to reopen it 5 years later as Scion Asset Management. This time, he was at the helm, steering the ship. Burry channeled his investment savvy into personal ventures, focusing on assets like water, farmland, and gold. These investments, somewhat unorthodox in the flashy world of hedge funds, underscored his penchant for zagging when the rest of the market zigged. The Big Short, while a cinematic tour de force, only captures a slice of Burry's story. The film, with its focus on the housing market debacle, showcased his acumen in shorting mortgage-backed securities. The upshot? A cool $100 million for Burry and a staggering $725 million for his investors. But the movie's lens narrows on the financial crisis, leaving out his subsequent ventures and the rebranding of his hedge fund. Burry's bold move against semiconductor stocks. Michael Burry, the maverick investor whose name has become synonymous with the prescient prediction of the 2008 housing market crash, is back in the financial spotlight. This time, his theater of operations is the semiconductor industry, where he has placed a short bet of $47 million, a move as bold as it is controversial. In an industry riding a remarkable 47% year-to-date surge, Burry's contrarian stance has sent ripples through the financial world, stirring a mix of awe and skepticism among investors and analysts. At the core of Burry's strategy is a belief that echoes his earlier foresight into the housing market, a conviction that the semiconductor sector is teetering on the brink of an unsustainable bubble. Despite the industry's impressive growth trajectory, Burry sees a mirage, drawing unsettling parallels to the 2008 subprime mortgage crisis. To him, this growth spurt in semiconductors is not a sign of robust health, but a harbinger of an impending correction. To bring his vision to life, Burry has employed a financial instrument that resonates with his penchant for high-stakes plays. Put options on the iShares Semiconductor ETF 𝐂𝐴𝐡𝐚𝐩𝐭𝐞𝐫𝐬. These options, akin to a gambler placing a calculated bet, give Burry the right to sell the ETF at a pre-agreed price in the future. Should the market's winds blow in his favor and the value of 𝐂𝐴𝐴𝐡𝐚𝐩𝐿 take a dive, these options could transform into a gold mine, potentially reaping significant profits. This latest gambit by Burry has set the financial community abuzz. Opinions are sharply divided. On one side, there are those who see it as another stroke of genius, a move that once again displays Burry's uncanny ability to read the market's tea leaves. On the other hand, skeptics abound, pointing to the robustness of the semiconductor sector, its centrality in driving technological advancements, and its entrenched position in numerous industries. These voices question the prudence of betting against a sector seemingly so vital to the global economy. Yet, Burry is no stranger to skepticism. His foresight into the housing market crash, once derided, ultimately etched his name in the annals of investment history. This track record, lends a certain gravitas to his actions, even as his latest move sends shockwaves through Wall Street. As the world watches with bated breath, the semiconductor sector continues its high-octane journey, fueling tech advancements and drawing investor fascination. Burry's daring wager against this backdrop serves as a stark reminder of the volatile, unpredictable nature of the markets, a realm where bold predictions and calculated risks can redefine fortunes and narratives. In a move that would raise eyebrows in even the most seasoned circles of Wall Street, Michael Burry, the investor known for his audacious and often contrarian strategies, has set his sights on Booking Holdings Inc., BKNG, the juggernaut of the online travel world. Despite BKNG's shares climbing a lofty 56% this year and the company posting robust Q2 2023 results, Burry has taken a bearish stance, securing 2,500 put options against the company. This action speaks volumes, signaling his belief that BKNG's market valuation is teetering on the edge of overinflation and might be headed for a downward correction. Burry's bet against Booking Holdings is a head-turner, especially considering the company's sterling performance in the S&P 500 index. It's akin to choosing to swim against a strong current. His skepticism appears to be at odds with the company's financial report card, a 72% jump in diluted earnings per share, EPS, and a 64% surge in adjusted EBITDA in the second quarter of 2023. Yet, for Burry, these numbers don't paint the full picture. Peeling back the layers, one finds that BKNG has not been without its challenges. It faced legal headwinds, notably a lawsuit from the Texas Attorney General's office accusing it of deceptive practices. The charge: advertising room rates sans mandatory fees, a strategy that could potentially mislead consumers and unfairly disadvantage competitors who play by the rules. The drama doesn't end there. Booking Holdings, a titan in the online travel industry, has shown its competitive teeth. It resisted changes initiated by Trivago to alter its display and processes. This resistance sheds light on the cutthroat dynamics that characterize the online travel agency landscape, a domain where corporate giants jostle for dominance. Adding another layer to this complex tapestry is Booking.com's strategic pivot. The company has been vigorously pushing a shift from its original agency model to a more traditional merchant model. This move is significant, representing not just a change in operational tactics, but also having profound implications for its business model and relationships with suppliers. In the pantheon of investment gurus, Warren Buffett, affectionately dubbed the Oracle of Omaha, holds a place of honor. Known for his shrewd investment strategies rooted in value investing, Buffett's approach is akin to that of a master craftsman carefully selecting the finest materials. He seeks out stocks that are undervalued yet have solid fundamentals, purchasing them at a discount and holding them as long-term treasures. This strategy, combined with unyielding patience, a laser focus on business fundamentals, and a fair-sighted perspective, has been the cornerstone of his legendary success. Buffett's investment playbook, steeped in understanding the intricacies of businesses, seeks out companies with bright futures in earnings, predominantly in sectors he understands intimately, like insurance, utilities, and consumer goods. This approach has solidified his status not only as a sage investor, but also as a teacher of sorts, imparting the wisdom of simplicity and depth in investment choices. But even amidst this landscape of calculated conservatism, Buffett's decisions have occasionally veered into the realm of audacity, challenging conventional market wisdom. His prescient insights, notably during the subprime mortgage crisis, have only added to his mystique, reminding the financial world that surprises lurk in even the most calculated forecasts. In a similar vein, Michael Burry, the prophetic investor of The Big Short fame, has once again entered the spotlight with predictions that resonate with Buffett's contrarian streak. Burry's recent bets against major indices like the S&P 500 and NASDAQ have proven astoundingly accurate, as both faced significant sell-offs. By the close of Q2, Burry's Scion Management Fund held put options on the SPDR S&P 500 and Invesco 𝐂𝐚𝐻𝐭𝐫𝐬 ETFs, presaging the subsequent declines of approximately 8% and 9% in these indices, respectively. Burry's bearish bets earlier in the year have drawn considerable attention, echoing his famed foresight into the 2008 housing crash. His recent success in anticipating the downturns of major indices has reaffirmed his status as a visionary with a unique grasp of market trends. Even amid occasional misjudgments, such as a premature sell call in January, Burry's recent triumphs have bolstered his reputation for making bold, contrarian investments. Yet, Burry's approach has not been without its critics. Voices like Kevin O'Leary, the billionaire investor from Shark Tank, have raised concerns about the inherent risks and unpredictability associated with such bearish stances, especially against stalwarts like the S&P 500. While the details of Burry's put options, including their value, strike price, and expiry, remain shrouded in mystery, the market correction they anticipated has turned the spotlight back onto his investment strategies. Although options trading offers significant leverage, the actual profitability and impact of Burry's latest maneuvers in the market are yet to be fully realized and understood. In the ever-evolving world of finance, the strategies of Buffett and Burry serve as a fascinating study in contrasts and similarities. Both demonstrate that even within the disciplined realm of investment, there is room for bold bets and unconventional wisdom, underscoring the dynamic and often unpredictable nature of the markets. Burry's pronouncements extend beyond individual stocks or sectors. He's been a staunch critic of the burgeoning passive investing bubble, a trend he believes is weaving a new web of risks against the backdrop of a bear market. This cautionary stance seems to resonate with market realities, particularly the corrections witnessed in the S&P 500 and the NASDAQ as of late October 2023. Fast forward to August 2022, and Burry's Scion Capital Management took a dramatic turn. In a move that echoed his growing apprehensions, the firm liquidated its entire stock portfolio in the second quarter. This decision was a stark indicator of Burry's escalating concerns about an impending stock market crash, a sentiment that has been a recurring theme in his commentary. Burry's penchant for dramatic gestures in the financial markets was further exemplified in February 2023 with a terse, one-word tweet, "Sell." This cryptic message appeared to be a direct response to the stock market's robust rebound in January, a rally that he seemingly viewed with skepticism. For more than 2 years, Burry has consistently raised red flags over asset prices and has been vocal about the potential for an economic calamity since the first half of 2022. His approach to the current market situation often draws parallels to historical precedents, such as the dot-com bubble, underscoring his deep-seated worries about the market's trajectory. Burry's warnings, far from being subtle hints, have been explicit and bold. His decision to offload stock portfolios under his management speaks to the strength of his convictions regarding the looming market risks and bubbles. As Michael Burry's predictions continue to stir the financial seas, one can't help but wonder, if he were to pen a memo to the market, would it read as a cautionary tale or a blueprint for navigating the tempest of Wall Street's uncertainties?